Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
It is January 13th, 2026, and if you are hoping for a quiet morning in global economics, this is definitely not it. We've been digging through a massive stack of sources today: CNBC, Reuters, Yahoo Finance, Bloomberg, and the theme is, well, it's impossible to miss.
Political risk is colliding head-on with economic stability.
On 3 continents, no
Yep.
less. It's a big one.
Right. So our mission for this deep dive is to shortcut you past all that noise, straight to what you really need to know. We've got 3 huge intertwined stories, and they're all driven by these high-stakes political moves.
We're talking about the Supreme Court's looming tariff decision. We have Germany making some really stark statements on Iran that are creating new trade friction. And then there's the criminal investigation into the U.S. Federal Reserve Chair.
Unprecedented. Okay, let's unpack this. We have to start with that ticking clock on trade law.
The biggest immediate financial risk is coming right out of Washington, specifically the Supreme Court. We are watching for a ruling possibly as early as tomorrow, Wednesday the 14th, on the legality of the administration's sweeping tariffs.
And this isn't just another trade spat, right? This is a landmark test.
It's a landmark test of the constitutional limits of presidential economic power. Absolutely.
And the rhetoric around it is, it's turned up to 11. Yahoo Finance is reporting on President Trump's social media post from yesterday, and I'm quoting here, "If the Supreme Court rules against the United States of America, we're screwed."
Yeah, and the reason for that dramatic language, it's the sheer financial liability.
Okay, so what are we talking about dollar-wise?
If the court strikes down the use of the IEEPA, that's the 1977 International Emergency Economic Powers Act, then importers are bracing for a massive $150 billion tariff refund fight.
$150 billion, that's a staggering number. It immediately makes you ask about fiscal stability. Can the Treasury even handle a payout that big without some major disruption?
Well, according to Reuters, Treasury Secretary Bessent says they can. He thinks the Treasury has more than enough funds, even if they have to, spread the repayments over a year.
But there's a catch.
There's a huge catch. And this is the real insight for the consumer. Bessent explicitly called the potential payout a corporate boondoggle.
A boondoggle. So he thinks the money's not going where it should.
Exactly. He voiced serious doubt that companies currently suing the government, he mentioned Costco by name, would actually pass those refunds back to you, the consumer, even if they win.
So the core issue here isn't just about presidential authority. It's also about whether any relief just fuels corporate profits instead of helping household budgets.
That's the billion-dollar question, and it speaks to the complexity these tariffs have introduced no matter how the court rules.
Let's put some numbers on that. Before this all started, what was the average U.S. tariff rate?
It was tiny, around 2.5%. Now, the Tax Foundation calculates the average is roughly 15.8%.
And some studies put it even higher for consumers, right?
Yeah, the Yale Budget Lab calculates the effective rate for consumers is closer to 16.8%. So we're talking about tariffs that are 6, maybe 7 times higher than just a few years ago.
And that's not just a cost, it's a complexity nightmare.
Oh, absolutely. Sources pointed out that the official rulebook, the Harmonized Tariff Schedule, is now over 4,500 pages long.
4,500.
It's more than 100 pages longer than it was just last year. That complexity itself is a barrier to trade. If you need a team of lawyers just to figure out the tax code on a shipment, business just stalls.
And we're already seeing that stalling effect in the job market. The reporting suggests that while consumers haven't felt the full cost yet because businesses are eating a lot of it, the uncertainty has made companies pause hiring.
Pause hiring, or in some cases, make immediate layoffs. That job market chill is a very real, tangible effect of all this political risk. And speaking of uncertainty, that same instability is now flaring up in foreign policy.
This is where it gets complicated. The administration just escalated things with Iran, and it directly risks that fragile trade truce we just got with China.
Right. Here's where economic policy and foreign policy just slam into each other.
Yeah.
President Trump announced an immediate new 25% tariff on imports from any country doing business with Iran.
Any country. And this is effective now.
Immediately, according to Yahoo Finance. This isn't a threat, it's happening.
And the geopolitical context here coming from CNBC is incredibly tense.
It really is. Iran is facing these widespread anti-government protests. We saw the German Chancellor, Friedrich Merz, call it the final days and weeks of the regime. That is a remarkably blunt statement from a European leader.
And human rights groups are reporting hundreds killed in the crackdowns.
It's a tragic situation. But the reason this specific tariff threatens the U.S.-China truce from October is simple.
China.
China is Iran's largest trading partner,
Especially for oil.
so this new 25% tariff, which could stack on top of existing duties, just risks blowing that whole truce apart.
How did China react?
Quickly and sharply. They stated they firmly oppose any illicit unilateral sanctions. So analysts are now flagging the primary risk, which is a return to a tit-for-tat trade war.
Which would kill any hope for that surge in U.S. soybean exports to China.
Exactly. That was a key part of the October deal. This just undermines all the trust that was built ahead of Trump's expected visit to Beijing in April. The market is now worried China is getting ready to retaliate.
So, more instability. Okay, let's widen the lens. How is the rest of the world responding to all this American protectionism? The first place to look is always the currency markets.
And right on cue, the Japanese yen just dropped to its weakest level in 18 months. Bloomberg has it at 159.05 per dollar.
And what's driving that slide?
It's a mix. There are reports of a potential snap election in Japan, which is creating its own fiscal policy uncertainty, but it's also reacting to the global trade environment.
And the U.S. is clearly watching this closely.
Very closely. Japanese Finance Minister Katayama was just in Washington meeting with Treasury Secretary Bessent. And Katayama said Bessent shares those concerns about the one-way weakening of the yen.
That coordinated language is a signal. So what's the magic number everyone's watching? The line in the sand.
The line is 160 yen per dollar. Why 160? Because Japanese authorities intervened 4 separate times back in 2024 when the yen got close to that level. It's a sort of psychological reference point for the Bank of Japan to step in.
And we know there's already been pressure on the BOJ to act on its own even before this.
A lot of pressure. Bloomberg's reporting highlights that Secretary Bessent has previously called for the Bank of Japan to just raise interest rates to boost the yen rather than, just intervening in the markets. So the BOJ is really in a tough spot here.
Meanwhile, other trade blocs are actively trying to build, well, economic lifeboats.
That's a great way to put it. The European Union countries just approved the Mercosur trade deal.
That's with Argentina, Brazil, Paraguay, and Uruguay.
Right. And sources in Yahoo Finance are framing this as a direct defensive response to U.S. tariffs and the tensions with China. It's all about diversifying supply chains and securing critical minerals. They specifically cited Brazil as a key source outside the usual power blocks.
Europe is also fighting for its own tech sovereignty, and that fight just hit the courtroom.
It did. A Dutch court essentially wrestled control of the chipmaker Nexperia away from its Chinese owner, Wingtech.
And this is about setting a precedent for what de-risking actually means in practice.
It is.
Yeah.
It's Europe asserting sovereignty over what they call legacy chip manufacturing. These are the older industrial-grade chips that are vital for everything from cars to factories. And Europe is signaling it's willing to risk disrupting global auto production if it means holding on to that expertise locally.
From one power struggle to another, let's talk about the AI boom. The demand from these new data centers is just immense, and it's starting to show up on our utility bills.
It really is. Sources reported U.S. utility bills were up 6% year over year back in August, and a big chunk of that is being fueled by the just insatiable power demand from AI.
This isn't some abstract tech story anymore. It's hitting people's wallets.
Which is why it's now a political issue.
Yeah.
President Trump announced that Microsoft will make major changes starting this week to ensure consumers don't pick up the tab for their data centers.
So the administration is stepping in.
They're acknowledging that this has become a strategic resource issue. They don't want citizens paying higher electricity bills to power a corporate AI arms race.
And we're seeing the corporations themselves scramble for solutions. Meta's announcement last week was a big one.
Oh, yeah. Meta announced agreements with 3 different nuclear power companies just for one data center in Ohio.
Nuclear. That shows the scale of the power they need.
It does. They're bypassing the grid and going straight to the source because they need that massive, stable energy supply for their AI ambitions.
And speaking of AI hardware, there was a quick but important clarification from NVIDIA.
Right. Reuters clarified that NVIDIA is not requiring upfront payment for its H200 chips. There were some earlier reports suggesting they were imposing really stringent terms on Chinese customers, but the company put that to rest pretty quickly.
Okay, let's wrap our deep dive with a story that really cuts to the heart of institutional stability: the Federal Reserve.
The Justice Department has opened a criminal investigation into Fed Chair Jerome Powell.
Now, this is tied to the Fed's, $2.5 billion headquarters renovation?
That's the official reason, yes. And what's interesting is that Wall Street, according to CNBC, basically shrugged. The market closed at record highs on Monday,
But the economists are not shrugging. They're sounding the alarm.
loudly. And the core concern, what Powell himself is saying, is that this probe is just another attempt by the administration to influence monetary policy.
The big so what here is the erosion of Fed independence.
That's the whole ballgame. And if you're thinking, well, if Wall Street doesn't care, why should I? The answer is that the damage isn't measured in a single day's stock performance.
So where does the real damage show up?
Economists like Mark Zandi and Martha Gimbel stress that it shows up years down the line. It manifests in inflation and borrowing costs. If the public loses faith that the Fed can operate free of political pressure, that loss of credibility becomes a self-fulfilling prophecy.
Leading to higher inflation expectations.
Higher inflation, higher long-term interest rates on your mortgage, on your car loan, and more stock market volatility because no one trusts the institution that's supposed to be guaranteeing price stability.
And this isn't just some abstract economic theory. We have a very specific and frankly chilling historical cautionary tale right here in the U.S.
We absolutely do. You just have to look back to the 1970s. President Nixon pressured the Fed chair at the time, Arthur Burns, to keep interest rates artificially low right before the 1972 election.
And that political pressure directly led to the runaway inflation of that decade.
It set the stage for it, peaking at around 15% in 1980. That is the exact path experts are warning about now if this kind of political pressure succeeds.
And the global precedents for this kind of executive interference are even darker.
Much darker. I mean, you look at the nations that suffered total economic disaster after their government seized control of their central banks: Argentina, Turkey, Venezuela, Zimbabwe. As one economist noted, that's not a list of countries anyone wants their economy to be like.
Which brings us to our final thought. We've tied all these threads together. The uncertainty around tariffs, the geopolitical tensions driving new trade friction, the power strain of AI, and now this direct threat to the independence of the very institutions that are supposed to stabilize the whole system.
And the final question this leaves for you to think about is this. The administration is openly pushing for lower interest rates. They want the Fed to act to achieve that short-term goal. The question is that goal fundamentally incompatible with the long-term, often painful need for stable prices? Especially when you look at the disastrous history of politically influenced central banking.
A huge question for the weeks and months ahead. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.